Okay, getting on a couple minutes here before we're gonna start, and you might be watching the replay, or you may be joining live here in a few minutes. I'm gonna do some housekeeping things here in a moment, and then kind of lay out our plan. And you might see me looking over to the side here because I have another screen and stuff. But before we get started today, I just want to take a moment and say that we need to be praying for our nation. I mean, always, our nation is in big need of God, but say a prayer for Charlie Kirk's family. For those of you that have followed the news today, he passed away. He was assassinated. He was a godly man that really took bold stands for the Lord, and what an example to all of us. So let's just take a moment. We'll pray for him, and then we'll be getting started here in a few minutes. Lord, today we come to you. And Father, we see hate and violence and wickedness, murder. Father, we pray for this man's family who has lost him, that you will be their comfort in this time, and we pray for our nation, Father. We need a touch from you. Lord Jesus, we have no guarantee of tomorrow, but in you we have eternal life, and we have hope, and we have forgiveness. I pray that if anyone does not know you that tunes into this video, that's the most important thing, and that they will be brought to a saving knowledge of Jesus Christ, I pray. Amen. Amen. So usually I probably would end more with a reminder to look to the Lord and to the gospel, but in light of the news, we see so much bad news. We need a reminder of the good news that's in Christ, and that he is the only way to eternal life. So pivoting a little bit now, we have another minute or so. For those of you joining, glad to see you there. I have another screen over here that I'm pulling up where I can see your comments. I'm going to go through a couple housekeeping things, and then we'll get started today. Again, you may be live, you may jump in live later on, or you may be watching the replay. So a couple of housekeeping things for those of you that are on the live video. This is live just for the coaching group. Appreciate you being here, and I'll go through kind of our trajectory here in a moment of how we'll spend our time tonight. But you can ask a question at any time in the comments. And for those of you that are watching the replay here in the group, still respond with a comment or a message if you want to ask something even after it's over. I will do my best to respond to those. For those of you watching later on, if the recording is on YouTube or something like that, you as well can go ahead and you can comment or find me on social media and contact that way. And when you comment, when you like something, that is kind of like a free digital tip to me. Just letting me know that you find value in a free offering like this, with a webinar, with a video. That just lets me know that adding value and something that is worthwhile for you. So I appreciate those likes and comments. Even if you disagree with something, it lets me know that there is a discussion, there is something that is sparking thought, and that is the intention. So as we get started here in just a moment, where we're going to go is I'm going to start off a little bit sharing about my passion, a little bit about my backstory and how I got into financial coaching. And then we're really going to spend some time on a lesson tonight, and then move into a Q&A. Again, you can ask questions however you want in the comments. I have some backup ones that I can reference as well when we get to that part later on. But we will be getting into some tips here in the middle. So as we settle in today, I encourage you to grab a piece of paper or something that you can jot some notes down on, because especially when we get to the lesson, there could be some takeaways that you'll want to remember. And writing those down, there's something that happens when our mind and our hand is writing something down and writing a goal or a takeaway. It helps us to take action and to get more out of what we're doing. So as we get started today, my passion for years has been working with men, and then it's expanded to working with couples. And I'll get into that a little bit as I begin now my story. As I was growing up, my dad always taught us about finances. And I think I was in high school when I went through the FPU program, Dave Ramsey's Financial Peace University, and began to see his baby steps. But I had exposure to Larry Burkett, I had exposure to Howard Dayton, and a lot of other ones, primarily in the Christian financial space. And then later on in time, I got more exposure to the secular world as well, and a little bit in the financial services industry, which I'll be sharing about in a few minutes when I get to that part of my story. But from the youngest age I can remember, probably 5, maybe even a little younger, I remember my dad teaching us about finances. And back in those days, we got an allowance, but I think it was when my parents began to be exposed to Dave, they kind of changed on that, because Dave kind of has this saying that you don't get paid being allowed to live. You work on straight commission, and you should be earning money that you have. But I remember having my dollar allowance, and my dad teaching us we had 80 cents we could spend, 10 cents to give to our church, and 10 cents to save. And I always remember when I was younger trying to find ways out of get out of saving, because I wanted to spend the money. I didn't want to save it. And as I got older, those lessons still my dad sought to instill in us. We would do extra work around the house, and then we'd save a little bit. We even had at one point a clothing budget, where we had to manage our particular budget and start taking care of that part of learning how to take care of a budget item ourselves. I remember when my dad also made me work to save up $100 before I could open my first bank account. I wanted to have a bank account, and my dad told me I had to earn $100 before I could do that. And so I actually did start putting in the elbow grease, and I had to earn that before I was allowed to open the account. And so I remember these types of lessons happening all the time, and then exposure to Dave, I believe it was near the end of high school, and just getting that path and that education down. But I certainly have not made every financial decision correctly. That's not what this group or what this seminar is going to be about. But Dave talks about how when he was saved and how he came face to face with the biblical principles of debt and saving and finance, that's what changed things for him. It was in relationship with the Lord and with the Bible that was part of his transformation process of going from bankruptcy to not. Now, thankfully, I've not been through bankruptcy, but I have been through different challenges at different times. And if it would not have been for paying attention to those biblical lessons and saving little by little and trying to be really intentional in college, I would not have been able to get the education I got if I did not manage things and think about it the way I did. I was blessed to have some resources I could draw on there, but I had to make decisions on how I was going to manage them. I had to make decisions on, was I just going to go down an educational and career path of racking up debt like you're pretty much told to in the culture, or was I going to work hard to see if I could do this debt free, which thankfully I was able to. The saving principles is really about discipline, and that's what we're really going to focus on when we get to the lesson here in a couple minutes. Dave talks about how finance is 10% knowledge and it's 90% behavior. Money really is not that hard to understand. It's really not. If you have less going out than you do coming in, then you're above the water. If you have more going out than you do coming in, then you're in the red, right? It's not that complicated, pardon me, but it is a discipline, and it's a consistent behavior that we have to have in order to succeed. Most wealthy, pardon me again. Sorry for that tickle in my throat. Most wealthy people I know, actually not a single wealthy person that I know, got there because they're living a luxurious lifestyle or they were just handed everything. I know people that have wealth, and the ones that do are they're frugal, and they still practice these disciplines. They still look at getting a good value. They still use coupons. They still use apps to be able to get discounts when they're going to their favorite restaurant or something like that, or their favorite place to get a drink or a smoothie or something. They are still living the disciplines and the habits. You never outgrow those. That's a little bit about how I grew up and how I got introduced to the principles. How did I move to financial coaching? Well, for about 2 years, I've been in the financial space. While I was a teacher, I was also with a company as an independent rep, working in financial education, and we did some insurance and stuff too. But I was doing that and helping do financial coaching with people, as well as to give them a customized plan. And then in that capacity, I was going down a path to be able to take care of insurance needs. And I was on this kind of traditional path. I then went to another company, and I loved it because of biblical values, and I went through a very extensive training process, which I like. But I came up against a couple of things that caused me to pivot. Number one, as I was training, I was in the training, and I don't do this. I decided I did not want to go down that route of training to be an investment advisor and to be an insurance agent. And, as I was learning about it and learning more about finance, I was like, I don't want transactional. I don't want to just sell an insurance product or just do investment advice. I want to really coach people. I want to help them have life transformation with their finances, and for them to be in the driver's seat, not for me to do it for people, which is what I was discovering was sometime, at least in how I was kind of being introduced to that. The second reason why I pivoted is because literally my Christian values would be, I would have a lack of integrity with the company that I was working with. They endorsed certain things. Now they had a kind of Christian motto and basis to what they did, and they claimed neutrality on LGBTQ and on pro-life and stuff like that. However, they were endorsing LGBTQ, whole DEI division, LGBTQ division, and for me it was a rather simple thing in terms of understanding this is a lack of integrity. As a Christian who is passionate about my faith and passionate about pro-life, and because the Bible does not endorse LGBTQ, it's harmful, I cannot endorse that. And it was an easy decision in that sense. It was a hard decision in the sense to say, okay, I'm going to have to walk away from this and figure out what else to do, and with the experience and the passion I have in this area. So before I left, I actually began the Ramsey process, and I've completed Dave Ramsey's, his Ramsey Solution process of Ramsey Financial Coach, becoming a master coach with them. I began that process, and then I completed it after I left. But again, the reasoning as well was not just my values, although that was part of it. I don't want to be ashamed of my faith. Now, I don't believe that of any of that type of stuff that you sow some money into somebody's ministry or you give to get, or the quackery that's out there about the health and wealth gospel. Certainly not that when I'm talking about faith. But being able to have a Christian faith and being able to believe in the Bible, speak freely about Jesus, nothing wrong with that. I certainly do work with non-Christians, but I do have a passion for working with men, as I have pretty much my whole life. As a teenager, I was involved in a program that was a lot like Boy Scouts, and I got passionate about mentoring my peers. And that's always stayed a passion. When I was a pastor, I was passionate about mentoring pastors, and I still do some of that. It's still a passion. I love walking with men and discipling them and mentoring them, and that is a component of finance as well. It rolls right into part of that and having that passion. And finance, like a lot of things, is a behavior and a discipline that is connected to other stuff. Are we being proud? There are many spiritual lessons that are also tied and reflected in our money. And so I love the fact that that's integrated in Scripture. Jesus talked a whole lot about money, and he did so to convey spiritual lessons. So I love the fact that I have the freedom to do that. And secondly, love working with couples as well. That has kind of expanded over the years of working with men, and then now also couples, being able to help them really establish a grounding in this area. It's a huge area of marital stress, finances, and the whole financial picture. I know that from having been in ministry in the past, and I know that from just having walked with men and again, in discipleship type of situations. So there is a deep passion behind wanting to help people, and a deep connection to things I've done in the past in terms of working with men, having passion to integrate faith and family values, and then the practical component of, okay, let's really get practical about applying biblical truths of discipline, of dependence on God, of stewardship, of wisdom, of planning. And let's be putting those things into practice in our financial life. So that's a little bit about my background and the passion that has led me to this and led me to this particular path and way to help people. And I love what I get to do in helping people in this way. But today for our lesson, as we kind of switch gears into that, and then we'll move into Q&A. And again, if you're jumping on, you can drop your question in the comment section whenever you want. And I look over here from time to time. I can see those no matter when you drop it in. I got another screen to be able to view those on. But I want to talk about what I would probably call as I was thinking about this today, kind of like the engine of personal finance. And I would call that the budgeting. One of the key things when there's a consultation with someone, or when I'm just talking shop, and I've done this for years, even before I was in the industry, just talking to a friend or talking to a guy over lunch that I'm discipling. It could be a completely different situation, and somehow finances probably comes up, or work. Are we taking advantage of our business, our benefits? Are you getting that free retirement match? What's your bills? If somebody is comfortable, do they want to share about how they're in debt? And I can throw out some strategies to help them begin to experience some freedom in that and get a handle on their finances. The foundation of it all really comes back to a budget. And if you're frustrated with budgeting and feel like it's impossible and you've never been able to make it work, you're not alone feeling that way. There's different ways to do budgeting. I have used an app in the past where you like link your accounts, and then you're able to put in your budget, and then you're able to match your expenditures to that. I've done that in the past. I've done paper and tracked it myself the old-fashioned way. When I was self-employed, I had to take it to another level. And going self-employed again, you take it to another level where you're not only planning your personal family finances, you're also then over here doing a business finances. And like, how are you going to pay yourself, and what do you need to save, and taxes, and it gets even a little bit more planning involved. But it all comes back to the budget, which is a plan. The place to begin with your budget is your four walls. Your housing, that could be rent or mortgage, your utilities, water, gas, sewer, electric. You may not have all of those. You may have a fully electric house, but which ones do you have? Your food and your transportation. Your four walls are the necessary components you need just to survive and to take care of your family. Those are the essentials. And when we can get on paper what those things cost, then we're able to look at what our income is. And if we are able to pay those things, then we can begin working toward discretionary spending. Where are memberships? Do we have a gym membership? Do we have subscriptions we don't need? Do we have insurance coverage that, that is a very important component to protect your family, different types of insurances. But do I have the most cost-effective way of doing it? And I'll try to go down that rabbit hole of explaining a little bit of that here in a moment. On the insurance side, because that's one that comes up in almost every conversation I have. And there are ways to save, and I'll throw out a bunch of tips here, so have your pen ready. I can also kind of explain the industry to you, how insurance agents get paid, and that might just be a little eye-opening and interesting to you to understand from the other side of the table how this is working. But as I was continuing before I dive into that, looking at those things, what's discretionary spending, and then debt. You're not alone if you were to be asked today, how much debt do you have and what are the totals? There's been multiple times I've had that conversation. But the big differentiator? When someone says, I don't know the totals, but I'm going to get back with you. And we talk about, okay, find out the current total. And again, there might be interest rates accruing and that total is changing, but let's get a number and let's list them. And then we can talk about debt paying off strategies. I think of somebody I talked to over a year ago that was in that situation. They actually made the decision to sell their house. They were able to then get rid of a lot of debts, and probably within the next couple years, if they keep working their plan, they'll be debt-free. They have a job they love. It doesn't pay as much, but what was being the biggest stressor for them was a lot of accumulated debts over the years. And to be honest, if they wouldn't have made that drastic decision, which was completely their own decision to make, they may have ended up losing the house at one point because they were already working a full-time job and a second job just to try to stay afloat. You may find yourself there. Are you living paycheck to paycheck? Do you not even know how to get through the month? There are tips and strategies we're going to talk about that can help you as well. This is not some webinar just for people that quote-unquote have money. As a matter of fact, we all can improve, and we all have areas where we can grow. And we all probably have an area of guilty pleasure. I'll share one of the areas with you that when I was single, and it's an area where even since I've gotten married, that my wife and I find ourselves sometimes needing to tighten up a little bit. And it's one that a lot of other people do too. So you may relate to this or you may even laugh at it. And that is eating out. I don't like to cook. My wife and I, we get busy. We'd like to just pick something up sometimes, rather not cook. That really adds up over time. And you know that. People live such crazy busy lives. You know what I'm talking about. We just grab something on the go, and then if we really sit down and we're looking at the budget and what's actually going out, that's where the power begins to really happen, where you can get a hold of your financial situation, of understanding where you're at and where you can begin to make steps forward when you can actually see where the money's going. What are the bills, and where maybe are there things I'm paying for on autopilot that I didn't even think of? A gym membership I've not used in 3 years. You know what? What if I call and cancel that? Save that $30 a month. What if I have Hulu and Disney Plus and all the different pluses and all different streaming services, and I cancel those? And I'm going to focus on paying down some debt. It's not easy, but again, what was it that Dave said? That, and I don't think I might not be quoting him exactly, but finance is 10% information, 90% behavior. The discipline, choices little by little. Let me now go back, and then we'll come back to the budget to talk a little bit about insurance. I told you I gave you some tips, and I got a bunch of them to throw out for you. I love throwing these out because if you put them to practice, it will take a little bit of time. I mean, you will have to possibly call up your insurance agent and ask about a couple things, or run some new rates and talk to a broker. But you could make some really big wins. And depending on what you're paying, this could really, really pay off and be really well worth your time. You see, there's two ways to improve our financial situation when it comes to having more margin in our budget and more margin in terms of what we're spending. One is to make more money. Two is to spend less. So, insurance. First of all, let me start with how the insurance world works. When you talk to an insurance agent, the way that typically works, if they are a captive agent, they are working for one company and they only sell that company's products. That's what they have to do. They can't go research other options for you. If you work with a broker, they can run options of multiple companies. Now, in my experience, not every broker, and it's just my experience, doesn't always have access to every option out there, but you're able to get more options they're comparing. So one example of this, let's start with how they are compensated, then we'll begin diving through them. How an insurance agent is typically compensated, and it depends on the type of insurance, is they are given a commission. Now that could be equal to 1 year's premiums. So if they sign you up for, let's just throw out a number there, $250 a month insurance. Let's do the math on that. Here's my handy dandy calculator, 250 times 12, and they make $3,000 off that transaction for you. Wouldn't you like that job? Now, it's nothing wrong with an insurance agent doing the work and getting paid. That's a commission, and then what they want to do is they want to keep you long term, and there in some cases may be a residual type of thing they continue to get a tiny bit back in other years, subsequent years, or they have the opportunity to sell you other things in the future. That's kind of how that industry works. So just understand there is a sales component. That's why working with a broker that can compare different options and find you a better rate, well, you're working with that broker because you want to get a better rate, and they're keeping clients by finding the best value and coverage they can for their clients. Strongly suggest you look at a broker. And if you don't know where to start, Dave Ramsey's website has tons of options and providers you can go through. You can do a coverage checkup, see where your current coverage stands, and then it takes like 5 minutes, and then they can tell you what areas you may want to look into. Go run the rates. Let's start now with auto insurance. So auto insurance. This is something that I run the rates on probably every 2 years, sometimes every year. And I actually currently am working with a captive agent, just in my own experience, because I've worked with a broker and they actually couldn't get me a lower rate, which is kind of interesting. And they still haven't when I've run the numbers. So that's the only reason why I'm doing that at this point. But I still have consulted brokers to compare my numbers. One thing that we were able to do is depending on your age, you might have a discount. So like I just hit one of the birthdays, and I also just got married last year. So that was one that lowers your rates. Let your insurance company know if you've had a life event like that. If you're a student and you're like on the A+ honor roll and you have good grades, you probably can get a good grades discount. If you have an emergency fund in place, you have some extra money to cushion life happening and unexpected things coming up. What if you raised your deductible on your car? If it's an older car, what if you went to liability only? Like, okay, this car is worth a couple $1,000s. If it gets in an accident or goes kaput, I'm just going to have to get another car, and I'm going to up the coverage just to have really good collision coverage, that type of thing, and be able to take care of medical stuff and injury to people. But I'm not going to really worry about the car because it's really not worth anything. It's reliable, gets me point A to point B right now. That's a great place to be. And so you can raise your deductible, maybe $500 to $1,000 or $1,500, which means you'd have to take care of a smaller claim. But you're able to lower your costs. The higher that deductible, and this applies to health insurance and all insurance across the board, the more you raise that deductible, the savings that you build to give you some financial security also gives you the ability to then save on all these others. So if the idea of having an emergency fund is something that you struggle with, or you wonder, am I really gonna have the motivation and discipline to do it? It can actually make a big difference in lowering your bills, because then you have the financial cushion to absorb those things yourself if something were to happen. And over here, you're able to save on these other bills. What are some other things with auto insurance? I've had multiple insurance companies, because like I said, I personally have shopped around. And with every company I've ever had, they all have, and they call it different things. They have some mechanism, whether it's an app or it's something you plug into the car, something that's connected to your phone and tracks your driving. It tracks your driving habits. And literally, I have seen a program with one company I was with where I could save 30% a year off my car insurance just having that, if I'm a safe driver. And just by doing the program, there's often some type of incentive. Paperless billing by having it all done electronically. Auto pay. Another way that sometimes you can save is some auto insurance companies, if you pay it all up front, you pay all 12 months up front, you pay it off in one fell swoop. Sometimes you can save a massive percentage point. Or some companies, you pay it like every 6 months or once a quarter. Maybe you don't have the finances to pay it off every year this year, but when you look at the savings, it might be something you want to begin to put in your budget to save to be able to do that in the future. So there's a couple things with the auto insurance. There's other discounts you can get too, bundling policies. I'll move into home and renter's insurance now, and which is one you can often bundle with your auto and home. And interestingly, I'm in a situation right now, to just talk about my own situation, to be transparent, where actually at the current moment, I have a separate company for my for this type of insurance, because they actually were a better rate than the bundle. So it does not work necessarily in every instance, but in many cases in the past when I've run the numbers, it has. It just has not worked out recently for me when I've done it. But it's definitely worth the research, because I have saved 9 times out of 10 over the years that I've taken the time to run these rates. Again, can't guarantee, but if there's a good chance you can save some money, that's probably a tip that I know many of you would probably be interested in. So when it comes to homeowners and renters, one is your deductible. Again, what is the deductible going to be? The other is what amount of coverage do you need? So you have homeowners insurance if you own a home. You don't want to pay for that roof if hail comes through and destroys your roof. That's what having that is for. Or if a tree falls on the roof and damages something. Having a good homeowner's policy protects you from a huge bill that, even with some emergency savings, would completely wipe you out and put you in a financial bind. So having insurance removes that risk off of your own liability to transferring the liability for a financial fee to the insurance company. Renter's insurance is something you should have if you don't have a home that you own. If you're in an apartment, if you're renting a home, if you're in a townhome, if you're in a rental situation, even if you're just staying with family, it's a good idea to have a renter's policy. You might even have in the policy coverage for a storage unit if you have that. It might carry over, and it might even carry over, if you read the details, into something like camping or when you're at a hotel or something. Look at the details of your policy. You might have some additional coverages or be able to add them. And then on both renters and homeowners, this is a type of insurance that people don't always think of, but this is the place that you usually can put it in. And that is like jewelry or collectibles insurance. If your wife has a wedding ring, you might very well want to insure it. And this is the place where you can add a rider many times onto your policy and get that covered in case it were to be lost or destroyed or something, to where it could be rebuilt, or to get the value of that back, to be able to get another ring or something like that. And for some people, that's prone. Like, I never knew this before, but once I was getting close to being married, I heard so many stories from coworkers about how they had lost or broken multiple wedding rings and engagement rings. And it's like, wow. So, it's not something that necessarily you want, but if it's something that you would value, this would be the place to put it in. And especially if you have a family heirloom that you want to make sure is protected, this is the place to talk to an insurance rep about getting that put in. Let's talk a little bit about medical insurance. Now, medical insurance is a huge one for many people, especially for those of you that are watching this that are self-employed, or in a small business, and pastors. Many times pastors, a lot of your churches don't necessarily provide that. Some denominations do. Chances are your denomination probably has some wing of it, or some partner, or even some separate affiliate organization. And I would encourage you to look at that first of all, to see what your quote-unquote employer or association benefits could be as an option. Another one that a lot of people look at is medical sharing. Now, many times there's a faith component to that. It's not insurance. It functions a different way, but it is a health coverage option, and that may make sense for your budget and your family, to look into that option as well. And there's many different options out there. But when it comes to your health insurance, again, there's some things you can do. If you have an employer's coverage, but you decide that you find a better deal on your own, whether you're going with like a medical sharing or a private insurance plan, if you do your own research and, hey, I can actually get better coverage paying for it on my own. If you're in that situation, then it makes complete sense to go to your employer and say, hey, I'd like to waive this. I found a better coverage for my family. Would you compensate me more since I'm waiving this benefit with the company? That's worth a conversation to have. Another thing you can do is it's based on your deductible. So again, if you have a higher deductible, you can get a lower cost. The other thing to look at is what type of medical service are you getting? Is there a network? What are the rates there? Does it cover your doctors? What types of things do they not cover? Having that is important to know. If you have a high deductible medical plan, which means it has a higher deductible and a lower cost to the plan, you then might qualify for something called an HSA, a health savings account, which these things are awesome. You can put money in and take it out for medical expenses, and you avoid taxes. And it's something where you can even be putting money into this kind of like people do with a retirement account. And as you're not using it, you can even then take some of that money and invest it, and it can grow. Either, growing for later on when you have other medical needs, or, to be able to pay off that deductible that you would reach. You might save more money in that because maybe you've been doing real well. You haven't been going to the doctor, for anything other than like normal checkups. And you're able to maybe, raise it because you've built that up over a period of time. It's a great benefit to look into and see if your employer offers, or if you have a high deductible plan, see if you can qualify to get an HSA on your own. Again, talking to a CPA, there's tax things surrounding it. I'm not, a tax person, but I will definitely say it is worth talking to a CPA. Legal advice, talk to an attorney. Tax advice, talk to a CPA. But it is worth your time working with those professionals and seeing what things are available to you. Then let's move on for a second to life insurance. Now, I'm going to tell you my personal perspective. It also happens to be Dave Ramsey's perspective. And I just still would recommend this. I know people that don't do that and choose not to, and it's always your choice. But when it comes to life insurance, there are two main types out there, and then there's lots of other names slapped on, particularly one of them. And that is, you have your life insurance that can be cash value or whole life, variable life. There's lots of names for it, but whole life insurance. And then over here you have term insurance. Term insurance is pure insurance. You have like a 20-year term. For 20 years, you're paying for life insurance coverage. And if you pass away, that dollar amount in the policy is then given to your family, whoever you've specified, so that they're taken care of. And the general rule of thumb is to have life insurance term life insurance that's 10 to 12 times your annual income. And the reason is then you can live off that is the theoretical sense, because the stock market has done like 11% over its history. And so the theoretical behind that is if you had the money invested, theoretically your family could live off the interest. Now, of course, there's no guarantee. I will address something on the stock market here in just a moment, because I know there's a question that many times, or objection that comes up when I mention something like that. But when it comes to term insurance, it is straight coverage. So when that term expires, or when you stop paying it and the policy lapses and goes away for lack of payment, then there's no coverage. Now, how whole life works is you pay much, much more money. I mean, it could be 10 times more or more for a lot less coverage. And what you're doing is it's supposed to theoretically give you insurance coverage for your whole life. And then when you die, your heirs or your beneficiary, whoever you leave it to, they might get $100,000 or something. A whole life policy, you might get $500,000, $1 million of coverage. Again, it could be a tenth of the cost. I've seen that. It depends on your health and what rates you qualify for and stuff, but it literally can be that different. What the whole life does is it has a higher cost because it has a quote-unquote savings component. And there are people that try to leverage this. They're very complicated. They're hard to understand. Here is some of the facts, though. Actually, when you look at how much the whole life insurance makes you, so if you use it as a savings account or a tax avoidance strategy, it gets on average like 1% a year, maybe slightly more or slightly less. 1% a year. That's not even as good as high interest savings account. They were like 4% a couple of years ago at a lot of places. So it's not a good investment from that sense. There are people that try to use cash value whole life insurance in order to like leverage debt. I know people that in the industry that want to use it to buy a rental property and then pay themselves back, or they want to use it to buy a car and then be paying themselves back their own loan from this policy. And it's very sophisticated, quote unquote, investing strategies. And the bottom line is, it's just really not worth it. If the purpose of life insurance is to take care of your loved ones if something happened to you and needed to replace your income to provide for them, you're going to spend a lot more money in whole life insurance. And if it's trying to leave $100,000 when you die to your family, again, if you simply save that on your own, 1%-ish versus, more in another type of pretty safe way of saving that, a bank account or something, you would do better. So, I know people disagree with me sometimes very vehemently on that. They disagree with Dave on it too. The choice is up to you, but I would strongly recommend, what is the purpose of your life insurance? Once you clarify that, which type of life insurance is going to get me to that goal? And I think your answer will be very clear, and what's most cost effective for you. Another thing, even if you have life insurance, rerun the rates. Like I did that recently. I never had life insurance as a single because I wasn't responsible for anybody. When I was getting married, I got that before I got married, went through the process, got that established, and then I actually reran the rates, and I saved money and got more coverage. So it definitely can be worth your time rerunning the rates on that as well. Even if you save $5 a month, that's $60 a year. And it's not only about having like just life insurance on the man or something. If you're married, it's a good idea to have insurance coverage on both of you, because if you have a family or if you're dependent on two incomes, you're going to be in the lurch. And when your family is grieving your loss, if the financial burden doesn't have to be there, that's going to be a huge blessing. So that's the purpose of life insurance, to transfer that risk and to provide for your loved ones in the event of an untimely death. Now, hopefully, you live to a ripe old age and you never ended up needing the coverage, and so you pay for it while you need it, and then You get older and you're self-insured at this point. You don't need it anymore. You have other assets to draw on, your house, your retirement, your family's taken care of, and then it passes its need. Now, there was something I was going to say, and yes, now it's coming back to me a little bit. I was going to talk about the stock market for just a minute. Now, I'm not giving investment advice, but I did want to say this. For people out there that don't understand what stocks and bonds are, here is just the simple 30-second explanation of what that is. Stocks are ownership in a company. You're buying a tiny piece of that company, and then if the company makes money, if it's profitable, as a tiny share of the owner, you're sharing in the profits. Okay. Now there's different types of stock and that type of thing, but that in a nutshell is what a stock is. Bonds are selling debt. It could be a municipal bond to a government, municipality. It could be a corporate bond to a corporation, business. But what a bond is okay, I'm going to lend you the money, and then you're going to pay me this interest rate back. Think for a second about how that worked for mortgage companies. 5-6 years ago, people are getting interest rates on their mortgages 2%. Now, a mortgage company that's writing a mortgage is getting what, 6, 7, 8%? Whatever the current rate is. It's a lot higher. And so there is a risk when you're lending money out for a locked-in interest rate. That's how bonds work. And there are varieties of it that even have to do with mortgages, like you're buying a share of all the mortgages at this mortgage company. But in a nutshell, that's what it is. And so bonds assume an interest rate. And you're locking in saying, I'm going to lend you this money, and then the risk I'm taking is that you're going to default on it. And what I'm hoping is that you're going to pay me that amount. Now, on the stock market side, people sometimes will say that you're going to put all your money in the stock market, you're going to lose it all. Here, that's virtually impossible. And I'm simply going to say that because if stock is ownership, if you're invested in what Ramsey is going to teach you and what any financial person I've ever heard would say is mutual funds, which is a collection of hundreds or more. It's lots and lots of different companies in one fund where you're buying a piece of this diversified fund of ownership of multiple companies. If you're invested that way in your retirement, and that's often the way the retirement plans with your work, unless every single company that is in that portfolio goes bankrupt and closes their doors and just completely tanks overnight, you're not going to lose everything. Now, the key when it comes to investing from an educational standpoint, not telling you what to invest in, but just from an educational standpoint, diversification. Don't put all your eggs in one basket and never invest in something you don't understand. Dave, actually, his organization, Ramsey Solutions, has done studies on millionaires, and they find that the average millionaire is not somebody that got a giant windfall of an inheritance or something. The average millionaire is actually somebody who used their retirement match at work. They got the free money, like, okay, I put in 6% and the company matches that 6%, and then they save whatever else they can over here in their own Roth or something. And they take advantage of that and they just save little by little, just like the Bible says. He who gathers little by little will see it increase, but wealth hastily gained will dwindle. That steady plotting that goes back to the budgeting of behavior is going to pay off more, and that's how most millionaires get there. It's just little by little, they're consistently every month saving, and here's how they select their investments. The average millionaire, when Dave's survey actually went through, they only spend 10 to 15 minutes researching a fund and looking at the info about it and looking at the track record of its performance, and then they invest, and they just keep investing consistently. And you know what? They might have one investment that doesn't do well. They have another investment that does marginal. They might have one that ended up doing really great, but most investors that are millionaires actually aren't super whizzes. It's not like they found the golden goose and then had this windfall. So I hope that can be an encouragement to you. It's the simple, consistent behavior and the habit of saving and living below your income that is going to build that ability to retire with dignity, rather than getting to retirement and being unable to retire because of these things. Or like sometimes when I talk to folks, and this is scary, I've talked to folks where they have trusted a family member or a friend or somebody to just invest and take care of all their retirement for them. And they're hoping that they have money when they retire. They're hoping that they'll be able to live off it. Well, here's the thing. I hope you have somebody good, because you're trusting them, and you can never blame that investment person if it doesn't go well, because you made the decision to do this. You're in the driver's seat. No investment advisor should ever be given complete control. You are the one that needs to know what they're doing and give them permission and what you're hiring them to do. You choose to give them authority in all your relationships, that's up to you. But what I'm saying is, you were the one that made the decision to enter into that relationship, and you are ultimately accountable for that. It's a sad thing. I've heard the story many times. People did well in business. They invested everything with somebody they knew, and they stole it. They invested it in shady stuff, and it's all gone. It's all gone. Know what you're putting it in. And here's the other reason. Even if you have the best person in the world with best intentions for you, and it all works out for you, here's the thing. You've not worked on your behavior at all for 40, 50 years while you were saving and building that retirement if they did everything for you. This goes back to part of my story. While I did not want to be an investment person and an insurance person, because I didn't want to just do it for people, I wanted to empower them and help them to take ownership and to really have the reins of what they're doing. If I just did it for everybody, then they're trusting me, and they're not necessarily changing the behavior. But it's the behavior change, learning how to live within that budget. If you can't live on a budget now, even if everything works out great and you have a pension or you have somebody managing everything for you and it all works out great and you can retire, if you can't stay under your budgeted amount in income now, what makes you think you're going to do that when you get to retirement? It's something to think about. Here in a couple minutes, we're going to begin to dive into some questions, so please feel free to drop those in the comments, and we will begin to go through them in a couple of minutes. I want to circle back around to the budget, though, and talk a little bit more about that before I dive into questions. When it comes to budgeting, there are different ways to do it, but essentially what a budget is it is a written plan. And again, it can be through an app or different means, but it is a plan of how you are spending. And even when I've worked in organizations, and even when I've been, quote unquote, the executive in an organization in the business world and stuff, when I've been in those situations in the workplace, I've advocated the same thing that I've done myself and advocate for people to be doing in their own finances, which is a zero-based budget. What this means is there should not be any more money going out than is coming in, or that you have retained earnings, savings to pay for. You might have that sometime. You might have a car breakdown in your personal budget and you have to do that. You might have something break on your business, or if you're in a church, on your house of worship, and you're going to have to dig into your savings a little bit to pay that deductible or something. You did not expect it, but you don't want to be in a position to where you're in the red. So when you're budgeting, you want to have as part of your budget, from an organizational perspective, to be saving a little bit. That's not greed. That's to be ready for those unexpected things, or those things that don't happen every time, like, hey, we need to do a remodel over here, or we need to deal with that little bit of mold that's growing in the corner in the building. Those types of things you're probably not going to see coming, and that's why you need to be saving ahead for, quote unquote, the unexpected, so that hopefully you're ready. And 9 times out of 10, it seems like when we're proactive and we're planning and we're working toward being prepared, it seems like many times things tend to go a whole lot better than if we have no plan and the bottom just falls out. The overwhelm, the stress of that, the lost sleep, it's not the place we want to be. And so a zero-based budget, the idea is to give every dollar a job. So as you continue to put those questions in the comments, again, I'll get to those in a moment. And before I do, I'm going to make this statement, and I'll probably repeat it one more time before we close. But I want to use an analogy of sports. If you've done sports as a kid, then you've probably gone through some coaching. Now, that's not everybody's passion, but if you've ever been part of a sport, or even at school, if you're on the team and the PE teacher divides you up and that type of thing, you have to go through all this stuff. What is a coach's purpose? A coach's purpose is to help you to be healthier, to improve your performance, to build more muscle and habit on the basics and the foundational skills of whatever sport or whatever exercise it is, to develop more well-roundedness and to help you get more wins. It doesn't mean that you're going to be a pro and that you're going to bat 100 out of 100, but their goal is to help you. Now let me switch that to another analogy. And here's where I'm going with this. Those of you that are part of the coaching group, I'm glad you're here. There's something in a setting like this where we do have the functionality that there can be commenting and a little bit more group participation, where there can be more interaction. And here are the 3 levels of information and how people tend to process change and make change in their life. And the question is, which one works best for you? Which one do you need? The first is information. So there's a lot of spectators of sports. Maybe you played when you were a kid, and now you go and you cheer, you turn on the TV and you watch it, and you're a spectator, but you're not in the game. And that's how a lot of people, in all honesty, interact even with like coaching videos or educational content, consuming the information, but really not taking action. A spectator, but not really getting on being part of the team. The second way is to be part of some type of support group. There's all types of these. There's Weight Watchers. I mean, you can pay just for the information. You can pay some company to give you a diet to follow and to do it on your own. You can pay a company to be part of a support group, and you go to the group meetings and you have some group accountability. There's a little more motivation, right, in a group setting where you go through a class, but it might not be, really deal with the behavior. It might help you lose some weight quick, but if it doesn't deal with deeper behavior, does it really produce lasting change? And then there's the one-on-one. You have a personal dietitian, you have a personal trainer, right? It's kind of the difference between having a gym membership that you may or may not use, really, but you can say you have it, and then you have, some type of group you're part of. Oh, I go to this group session and I, do a couple of things, or I jump in and participate a little bit. I'm part of a group, feel a little better, maybe a little bit more motivated sometimes, but that may lax off. And then there's one-on-one. There's more accountability. A personal trainer. And essentially that's the difference. We have information through this type of setting in a webinar or the videos, and I appreciate that almost 70% of you, the statistics show me, look at the videos and stuff on the group. And I appreciate your interaction. When you ask questions and like stuff, it lets me know I'm adding value. It lets me know that something is hitting home. Lets me know if there's a question or something I could clarify better next time. Helps me hone and get better at serving people. But that level doesn't produce transformation for most people. Sometimes there's a little nugget or something that helps you, but then you move into a group setting where you have a small group. A lot of you do this in your churches. You have some type of small Bible study, a smaller setting where you're able to learn more and be more personal and have more accountability. And then you have the real intimate type of group. Personal trainer, a coach working with a couple to work on their finances or their health or their marriage. It can be a lot more effective than producing that change. So as we go through a couple of the questions here, I'm also going to pull up the log that I got. And there's certainly more we could say about budgeting. There is so much that can assist and help with that. But for sake of time, I'm going to have to leave it there today. But hopefully you got some good tips on some ways to save on your budget, and especially the insurance realm that we talked about, and some ideas on how to give every dollar a name and begin jotting that down. It takes some time. It can be a little frustrating, and it's never a completely one and done document. Life happens and things may tweak, an unexpected expense. But when you begin to get more of that down and begin to work with an intentional plan, you begin to build traction. And even if you're single, having somebody that can help hold you accountable on that and work with you on your plan is excellent. Okay. One of the things I'm seeing here when it comes to financial fundamentals, a question that people often ask, and perhaps this is the question that you had in mind, is the difference between prioritizing needs over wants. And this goes back to earlier when I was talking about, do you have a gym membership you're not using versus your 4 walls? Do you have your housing, your food, your utilities, lights on, heat on, water on, sewer on, and your transportation so you can get to and from work, get your family the places that you need to be? Do you have those 4 walls taken care of, those essentials? Or is it going into your wants? Is it a vacation? I'll illustrate this in one sense in a way that it's actually a situation that kind of made me a little angry. When my wife and I were getting married, before we did and leading up to it, and then even close to the wedding, I heard something that, I didn't do anything, but it made me a little angry because what a lot of people were seeming to tell us was just go all out on your honeymoon, put it on a credit card, just, go all out, blow it, because you're only going to be able to have a honeymoon once. You're only getting married once. Spend the money, have this crazy thing. And I strongly would say you don't have to think that way. You don't have to do things that way. You can have a wedding that you can afford. You can have a honeymoon that you can afford. And we did. We paid for it. We were able to book it with a certain amount and then pay the rest in full before, without having to pay interest or anything, before the honeymoon. And it was tight. It was something we had to pay for, but we paid for it in cash. And we spent a little bit of money on the honeymoon, but we didn't go crazy. And here's the reason why I would say that. If you make exceptions for situations in your habits where it's okay to blow it, and this kind of goes into that category I talked about before of, wanting to spend money on buying food because I don't want to cook. That's a decision I sometimes make, and it's not always the best decision. Now, it's not wrong to enjoy some things and enjoy that every now and then and have a special date night and that type of thing. But if I do that all the time, I'm being very foolish, and I'm being very immature in not having some discipline to say no. So, I looked at that, and why it made me a little angry was I was like, no, I don't want to begin our marriage in debt, paying off our honeymoon and paying off our wedding. We want to have these things paid for and work within what we have so that we can enjoy the day, but then also enjoy our life. And so it's a different way of thinking. But again, if you avoid debt, hey, you can jump faster on saving for that first home. So a different way of thinking. Is it a need or a want? Where is the money going? Okay, this is a really good question that I'm seeing here. So let's dive into this one a little bit. That was a great question. Oops. Well, my other screen just went a little wonkers. Hopefully that comes back up. So the question essentially is this: what's the difference between like a high yield savings account, a money market, understanding different types of savings? So the purpose of savings, whether you're talking about an emergency fund, which, the Dave Ramsey baby steps, you get $1,000 in the bank, or if your income is under $26,000 a year, then you aim for $500 in the bank. That's a starter emergency fund, so that you have something there to help when the circumstances of life hit you. So it's not something hopefully you're scrambling to pay for, at least not one of those more things like the air conditioning went out and we need to go have a repairman come fix it. Hopefully $500 can get it up and working. I know some are saying that would not necessarily do it. It depends on the nature of the problem. But the purpose of the emergency fund is that. Now, a fully funded emergency fund is 3 to 6 months savings in the bank of what you need to pay your bills. And that's to give you protection in the event of job loss, more extended illness. It can eliminate the need for short-term disability insurance by being able to wait for 180-day, 6-month insurance to kick in, because you could absorb the cost on your own. So there's a lot of reasons why that's recommended, and that's not just a Ramsey thing. Tons of financial educational folks and teachers and educators, they talk about having 3 to 6 months in emergency fund. But what's the difference in savings options? Well, a high yield savings account is where you're getting a higher rate of interest for your savings, to just make it simple. So, some banks, a theoretical example, they might pay like 0.25%, like 0.25 of 1% or even less in your savings account at their local bank or something. A high yield savings account is one that pays more. It might be 3-4%, something like that. It's a savings account, which means that, if you go with an FDIC insured bank, there's a certain level of coverage on that money. And what the bank does is they take your savings and they're lending it out in order to then pay you the interest. And so that's what they're doing. And it's a way that, again, the high yield, you're making more than what a lot of the other kind of underliers are. What about a CD? A CD is a certificate of deposit. That's one where you're locking in your money for 9 months, 6 months, a year, 2 years. And then when that term is up, you get that interest rate. You get that extra money that was locked in, whatever rate it was at. It's kind of like a bond that I described before, is kind of what that is. but it locks the money in for longer and you can't take it out without penalties. Now, some businesses and organizations use that to kind of stagger their savings. But that's what that is. Then what a money market is a money market is another savings option where you're able to put the money in. The difference here is you usually get more of that high yield savings amount. And then you're also able to get in and out of it. It's not something that you're locked in like with the CD. So that's a great question. What about automated savings? Okay, that's a good one as well. Automated savings is when you set up with your bank account to automatically take out of your paycheck and put something in. Or it might not just be your savings account. It even could be to take something out of your paycheck and put in your retirement. A lot of you probably have that option if you work for a traditional employer where you can put a certain amount of money automatically off your paycheck, out of your paycheck into your retirement all the time. And I referenced that before when I talked about how many millionaires, they take advantage of the pay match. So what this means is if your company has a like 401k or 403b or investment option where you can put in 4% of your salary, your income, and they match 4%, great. Now some of them have a vesting period, meaning you have to wait 2 years, 3 years, 5 years before you get to keep whatever they put in to match it. So you have to stay with the company that long. But some of them don't have that requirement. Bottom line is it's free extra money that they're putting in. And so that would be great. Now, I will say this when it comes down to Roth and traditional options, whether you're talking IRA or 401k, this is kind of a spin-off question that it's really important to understand the difference on. The way that Roths function, because of a gentleman, I believe, with that last name that had the legislation passed, is a Roth allows you to pay the taxes on the money going in. So let's say I make $30,000 a year. I put $2,000 into my retirement. I still pay taxes on $30,000 a year. But that money that went into the retirement account, I've already paid taxes on it. So I was taxed once. It's going to grow, and when I take it out in retirement, I don't have to pay tax on it. Also with Roths, there's typically not the required minimum distribution, which is nice. If my memory serves me correctly. With traditionals, there is. With a traditional 401k, not a Roth option, or traditional IRA, you're putting the money in, but here's the catcher. And this is how they sell it to you, but it's kind of, a little scammy. Put the money in, you don't have to pay tax on it now. So again, the illustration, I make $30,000. I put $2,000 this time into a traditional 401k or a traditional IRA, but I only pay taxes on $28,000. That money sits there and it grows as I invested and keep putting into it until retirement. I have to take out at a certain age the required minimum distribution, some amount. So I'm required to start taking out and I have to pay taxes on it then. Now, what you're looking at is, do you want to pay taxes now or pay taxes later? If you actually look at the historical data, I found this out in a training about 2.5-3 months ago. Taxes are actually at all-time low in American history. Back during like World War I and II, they were like close to 90% or something for top income earners. They're actually very, very low, if not the lowest they've ever been now. So, you're going to make the decision you make, but especially if you begin to build some real progress over 30, 20, 40, 50 years of working, if you're then in a higher tax bracket, you're going to pay more money if you wait, most likely, to pay taxes on that when you're taking it out, rather than doing it now. Then there's also Roth rollovers based on your tax bracket where you roll over a certain amount, like to get up to the peak of your tax bracket, and roll it over from a traditional to a Roth so that you're paying the taxes now and being able to avoid that later on in retirement and, being able to take advantages. So those are some really good educational pieces, and I think I'm going to stop there when it comes to the questions. All right, well, I want to first, pardon me, talking too fast. I want to thank you for hopping on this, whether you've been able to be live, appreciate those of you that have, or whether you're watching the replay in the group. Again, if you're watching the replay and you're in the group or you're doing this later, please feel free to still drop a question, or you even can private message me. And if you want to look at a group coaching situation, or you want to look at that individual type of coaching option, as I mentioned, for the motivation and the real progress on working on your goals and having more accountability to stick to the plan that I talked about and illustrated before, would love to talk to you about that. Consultation doesn't cost a thing, so if nothing else, jump on the consultation. You may say, there's no way I could afford coaching, there's no way I could afford some type of group, my budget is too tight, I'm barely making it. That's okay. Let's still have the consultation. I would love to talk with you, love to see where I can add some value in that consultation time to help you begin to make some progress toward your goals, because you can do it. Begin to roll up your sleeves, put together some elbow grease, you can begin to make progress. That's the great thing, is that you do have control on what your choices are. So thanks a lot. I do apologize that this was more of a lecture format. In the future, I'd love to have more interaction to get more of you on the group. I know maybe that because we were on a Wednesday today at this time, maybe that was part of the reason why. Feel free to let me know that too. It just the timing or the day that didn't work as well for you. But appreciate your time again. Apologize for going over a couple minutes. Hope it's added value to you. God bless, and continue to talk to you guys next time and to interact with you in the group.